Well, welcome everyone to tonight's asset protection webinar. We are delighted to have tax attorney Scott Estill with us. He was a former senior trial attorney with the IRS. Since then, he's been in practice for himself for over 20 years. We're so delighted to have his expertise and his friendship throughout the years. So, a couple quick announcements before we get too engaged in tax. We do have an upcoming 3-day summit. It's coming up November 11th, 12th, and 13th. That's a Monday, Tuesday, Wednesday. We're back at Green Valley Ranch Spa and Resort. If you haven't been there before, it is a spectacular 5-star hotel and spa. You've probably got 40 restaurants within a 2-block walking distance. You got almost anything. But our group rate, we always negotiate with Green Valley Ranch. We negotiate pretty hard to get some really good group rates. Group rooms usually will start at $219 a night. We've got them down to $145. The resort fees are cut in half for our group. It's a spectacular venue for us to go there, and they've taken really good care of us over the years. Our students absolutely love the resort. So, but we also have not just a great resort. We've got some of the best speakers in the nation. Clint Coons will be there. Scott will be here. We've got the last event we had Jill Banner. We were delighted to have her back. We haven't seen her very often in the last 3 or 4 years. Aaron Adams was with us. Mike Koval will be with us. Stacy Acevedo, Gene Garino, and several others. We're delighted to have really some of the best friends and some of the smartest individuals. I really feel honored to be in their presence. It's a delight to have this many really good, solid trainers, teachers, but really good people with heart that have teaching, just a love for teaching and watching students' lights come on. The speakers spend a lot of time with students. This is a one-on-one kind of experience. Yes, we teach from stage, but there's a lot of time to sit down and meet with the individual instructors and their staff. So we're delighted to have you come. If you'd like an agenda, if you've never been to a summit, the agenda is posted. It's a sample agenda until we get a little bit closer. It'll probably, but it's not all that different than what we've done in the past. If you're looking for continuing education credit, that is almost always available. So a lot of people will bring their CPAs, their attorneys with them, their bookkeepers, whoever's going to be doing some of the major lifting if you're not going to be doing it yourself. So that's available. And then one other quick thing, and that is the registration. The group rate ends October 21st. And so we invite you to get registered as soon as you can. If you can register today, if you know that you're going to be coming, get registered today. Go to protectwealth.com. It's pretty simple registration. It's not difficult, and that class is filling up really fast, which is why we're kind of encouraging you to do it as soon as you can. All right, before we get into taxes, there is always a legal and disclaimer, legal and tax disclaimer. The principles that we'll talk about this evening are general by nature. That can't be assumed that everything we talk about applies to you in your tax situation. That's one of the reasons we encourage you to come to the summit, where you can sit down, meet with the professionals, and discuss the options. So our goal tonight is to talk about real estate investors, how the tax advantages, the tax traps for real estate investors. And all of you have different situations. Some of you are flipping, some of you are holding, some of you have commercial, some of you have residential. We're going to be talking about general principles, but at the summit we can get a lot more specific than we can here in a setting with 100+ people. So with that, let me turn the time over to Scott Estill with just a brief introduction. We've run an asset protection hotline for 21, 22 years now. And the most frequently asked questions are always about real estate holdings. Stock market's fairly straightforward, at least on the asset protection side. But when it comes to asset protection and taxes for the real estate, it can get complicated. And so we're delighted to have Scott to kind of walk through this. The way we'll structure this webinar tonight is it'll be open. Scott's going to speak, take notes if you would, and then at the end, probably he'll teach for 45 minutes or so, thereabouts. And after that, we're going to open it up to questions. And so save your questions until the end, and then we'll tackle them one by one until our time is up. So Scott, so delighted to have you back. Thank you for being here. We're going to turn time over to you.
Great. Thank you so much, Don, and always my pleasure to be able to do another webinar here. And tonight what I want to do is just talk about some very basic real estate tax planning strategies. And like you had mentioned, this isn't a one-size-fits-all sort of a deal where whatever we talk about tonight is going to apply to everybody. But what I want you to think about tonight while you're listening or watching or doing whatever you're doing for this particular webinar is to think about the mindset, to think about what it is that you can do with your particular situation to go ahead and do some tax planning. Because we've seen just so many people in the real estate realm where you get in and maybe you're really good at finding rental properties at a pretty low price, or flipping properties, or whatever it happens to be. But how many people that are listening to the call tonight really feel like they have a solid tax plan in place? And I'm not just talking necessarily about even real estate, but just with your business or with your personal affairs. But again, most of us don't have that. And what we're going to talk about tonight are just some thoughts and plans as far as the real estate tax strategies go. I want to begin with the first question that I would ask if you came into me and said, well, we need to figure out what we're going to do with this property. You know, how are we going to tax it? What kind of a business entity are we going to put it in? That sort of thing. The first thing I'm going to ask you is, well, what are you doing with the property? What is it? What's the plan? And so we would have a very different tax plan if this is buying your primary residence versus maybe buying a second home, or maybe buying an investment property, or you're going to buy a rental property, or you're going to fix and flip a property. Whatever it is that you're deciding to do, that's going to be our initial consideration, is what is it? And I think once we know what it is that we're trying to do, then we can start looking at, all right, what kind of strategies do we have? What kind of strategies can we implement in our situation that's going to give us the best tax plan for what it is we're trying to accomplish? So again, if we go back and we say this is our primary residence, fine, we're not going to go into different plans for rental properties, or if we're fixing and flipping properties, very different tax strategies than we would with an investment property. So we look at the real estate tax strategies and some of the things that we need to keep in mind. First one is real estate professional status. And each one of these bullet points, by the way, lend themselves to an entire presentation. So I've done 30 to 60-minute presentations on each one of these bullet points. So obviously tonight isn't meant to delve into these real deeply, but just to understand that if you are a real estate professional and you qualify, very, very good from a tax perspective, meaning that real estate professional, you work more than 750 hours in real estate, and more than half of your business time. So you put these together, and if you qualify, good deal. Bonus and other depreciation, cost segregation. I'm going to talk about some examples and just to show you how the new tax law and the bonus and the other types of depreciation really come into play for rental properties. It can make a huge difference as well as to whether your rental property is a real good investment, let's say from a cash flow perspective, or a great investment when we combine the cash flow with all the tax benefits that arise with the rental property. So looking at the rental property as opposed to a personal residence, and that little $250,000, $500,000 number there, I'll talk about that in a few minutes, but it applies to some capital gains exclusion. So again, we need to know what it is that we're doing with the property, because if we end up with a rental property, let's say, we do have these Section 1031 exchanges, we do have opportunity zones. And again, I've talked about these in other entire webinars, but I will touch on them later on tonight as well. We can trade real estate or use real estate in our IRA, whether it's a traditional or a Roth IRA. So we can have rental properties within an IRA. We can also use installment sales, where that's a period of time where we may do an owner carry, where I may sell you my house, take back a 10-year note, and I can spread the capital gains then over a 10-year period. So we're looking at ways that we can maybe not have everything taxed all this year, but maybe push some things out to a future year. Potential qualified business income tax deduction. This is a huge one, and it's one that we spent actually quite a bit of time on at the Dallas event, the 3-day event that we just finished, and I'm going to even devote, I think, more time at the Las Vegas event to this, because it's such a huge tax deduction when you start looking at potentially 20% of your income coming right off the top and never having to pay tax on it. This qualified business income, it's a new tax deduction, but it does apply to real estate investors. And so again, I think as each of the 3-day events, as we keep going with it, my talks kind of change each time depending on where the law and the tax law is going. But this QBI is a huge, huge deduction. And I've seen it already save people, high income folks, 6-7 figures in taxes. So it can be a massive amount of tax savings. Renting your home, we've talked about that in the for the personal residences, and I'll talk about that in a few minutes as well here. But I think you can see that there's just so many different strategies that we can implement depending on what it is that you're planning on doing with the property. So when we buy the property, from a tax planning perspective, I like to think about what is it we're going to do and what's our exit strategy. So when we buy it, are we planning on renovating it and flipping it and hopefully holding it for a really short period? Or is it something where this is more going to be a buy it, put a little bit of money into it, or maybe none at all, rent it out for a long period of time, certainly more than a year, and then at some point sell it or trade it or do something with the property to be able to cash out the value. So when we start planning for the property, we still want to look at what's our exit strategy, even though that may be something that's years or decades down the road. So how long are we planning on holding it? And once we know that, we can sort of have projections as to what kind of appreciation is this going to be as far as the future. How can we plan tax avoidance today as far as using some of the deductions for rental properties, or maybe using depreciation or bonus depreciation, or using our IRAs or like-kind exchanges, or any of these very numerous different strategies that we have to be able to avoid taxes and to be able to get to a position, right, where we don't have to worry about our tax plan because we have it in place, right? And so we don't end up looking like this kid on the screen here, where you get that look, and I got it when I was preparing taxes, where, man, I don't want to hear what you're telling me as a tax pro, and I get it. But let's not get into that situation. Let's make sure that we know what we're doing. So rental property, pretty straightforward here. Any expenses that we're deducting, ordinary, necessary, reasonable, those all sound like tax terms, like lawyer-esque sort of terms, and they are. But ordinary, necessary, reasonable, kind of what you would think they are. Is this common? Is it helpful? Is the amount reasonable in nature? And so we look at this list, and it's not necessarily an all-inclusive list, but most of us know we can deduct our interest and taxes that we pay, but can we claim HOA dues, or what about travel, or how about repairs and maintenance, or depreciation, or our meals? And so you can see by this list that pretty much any expense that directly relates to the operation of our rental property, you got to go and get it cleaned now, or maybe you're in between tenants, or whatever it happens to be. You've got to paint in there. You've got to go visit the property to do repairs. All of these expenses become potentially tax deductible. And so whatever they happen to be, we need to make sure that we keep good records. Now, one of the things that comes into play during an audit, always with these expenses, is IRS comes in and wants to know if your particular expense is a repair or is an improvement. And that's one that we see a lot in audits, but I think we're going to see a lot less of that in coming up in audits. And the reason for it is that prior to today's laws, if it was a repair, we got a full expense for it. So if we spent $200 to get somebody to come out and fix some plumbing, that $200 expense was deductible right off the top. But if it turns out that that was an improvement, let's say I'm taking out the cabinetry and the plumbing and what have you in the bathroom and putting in a new bathroom there, then it can be an improvement and it would have to be depreciated. And so we would lose a lot of the deduction up front because we'd have to take it over time. The reason I say that we're going to see a lot less of this in the future, I think, concerns bonus depreciation, but it also concerns this election to expense, this sort of what the IRS calls a safe harbor, in that we can say now that up to $2,500 per item of this repair or improvement sort of a question can now be immediately expensed. And that $2,500 is per item of property. Okay, so it's not total for the year, it's for whatever we're doing with this particular item of property. Now, in order to have this happen, have to make a tax election on the return. Just make sure that if we're using this and we're trying to maximize this $2,500 amount, that your accountant puts this tax election on there so that you don't miss the that particular deduction. So anyways, with the taxes here, and I don't want to see anybody end up here like Dwight here from the office, and that very easy, right? Don't make money. What I'm hoping for tonight on this webinar is that you all make a whole lot of money, and you're going to have big tax problems. Big tax problems meaning you just made millions and you're trying to figure out how not to pay millions to the government. So we have to look at all different strategies, and all of the expenses that I had listed before were kind of expenses that you're pulling out of pocket. So you've got to pay the plumber $200. You've got to put in a new heater or air conditioning unit for $500, or whatever these costs are. These are costs that are coming out of your pocket. What a lot of people don't look at from the business perspective is, what are the tax benefits of holding, let's say, a rental property? And up here on the screen, you can see that big difference between a residential building and a commercial building, and understanding that we don't depreciate land. But it's the bottom two bullet points here. The ones that are 5 years and the ones that are 15 years are where a lot of the tax game is being played today, and where the tax game is really going to be won or lost. So let's take a look at simple example number one. Okay, and I mentioned simple example, very easy numbers here. What I'm doing is I went out today and I bought a rental property for $150,000. I've determined through the assessor's office that the land value is 20% of my purchase cost. So I back that out of the 150 and I come up with a building value of 120,000. Divide that by 27 and a half years, which is what the depreciation rate is for a residential property. It would be 39 years if this was commercial, but for our purposes, 27 and a half. Divide that into the 120, and we come up with an annual depreciation of that 4363 number there, or in effect, a $363 per month tax benefit. So this is not something that you're paying for every month. This is just something you're getting as a result of owning the rental property. So if we look at the cash flow analysis, and almost everybody that buys rental property, if you're not buying it solely for appreciation, you certainly want to know what the cash flow is. So let's assume that after you take in all of your income and all of the expenses out of pocket, let's say that you come up with a $350 a month cash flow. When we depreciate this, we can now subtract 363 from the 350, and even though we had a property here that was cash flowing positive, we're getting a tax loss here. And so we're actually going to lose money on this tax-wise, even though it was dumping $350 a month into our pocket on a cash flow basis. So that's one of the real benefits of having these rental properties. Now, one of the other benefits is, if we go back to this prior example, our number one here, our basic example, and say we really like this $363 a month extra amount in our pocket, but what can we do that would make it better? And this is where bonus depreciation comes in, and it's something you're going to want to talk to your accountant about. Do I qualify for bonus depreciation, whether it's in your business, whatever it happens to be? So it works in my law practice, it can work in your grocery store, it can work in your restaurant, it can work in your real estate business. If you're a stock market trader, it can work for you as well. But bonus depreciation, we can get a 100% tax deduction for using bonus depreciation. And it can apply in real estate. And here's where it comes into play. Any of this property that is 20 years or less of a depreciation period. I'm going to flip back a couple slides here and just show you why I said these two last bullet points were so important, in that appliances, carpet, personal property, land improvements, all of those particular items of property are either 5 or 15 years. So either way, they're less than 20 years and qualify for bonus depreciation. So we can basically take this, our number one example, use this bonus depreciation with respect to our real estate, and use an extra depreciation because we have property that's just 20 years or less. So what does that mean? Well, we can look at some of the eligible property and we can say, do we have carpet here? Are we putting in, maybe I'm buying a rental property and I'm ripping out the carpet and putting new carpet in, or putting new appliances in, or perhaps doing new landscaping, driveways, sidewalks, new trees, flowers, whatever it happens to be, resodding the grass or putting new grass seed in, using equipment or tools, or maybe computers or cell phones, or you can see, I think the list can go on and on and on as far as what sort of personal property could you be using with respect to your rental property that qualifies under either this 5-year rule, like the carpet and appliances, or if the computers would, or this 15-year rule, which is our bullet point 3, the landscaping, driveways, and things like that. So we've got this eligible property we're using, and we have the ability to also use, with bonus depreciation, this cost segregation analysis. And it's just a real big kind of fancy tax term for being able to take out some of the personal property that's in the real property. And so what we're doing here is that we're trying to increase our depreciation, because instead of depreciating something over 27.5 years, maybe we're depreciating it over 5 years. And so when we look at cost segregation, sometimes this doesn't really pay out as far as maybe a small rental property goes. But when we get into more expensive rental properties, when we get into certainly commercial buildings where the cost of having a cost segregation study done is going to more than offset by what the tax savings are going to be. But again, we want to know that these options are available, that we do have cost segregation available, we do have bonus depreciation available, and it's just going to be a question of, does it work for you? So let's go back and look at the possibilities here. So this is the slide that we've seen a few times already, and our starting point. Again, this $120,000 building divided by 27.5, and we get the $363 a month in our pocket. Whatever. Okay, that's all good. Bottom line though is we can do better. What happens if we take that same building that's worth $120,000 and now can take out $20,000 of property that I have this 5-15 on? What I'm talking about there is the amounts that are available on a personal property, your appliances, your carpet, your landscaping, your sidewalk, driveways, all of those things that are either 5 or 15 years. What happens if we can pull those out? So we pull those out, you can see that the basis of the building is going to go down because we're taking out another 20,000, but instead of depreciating that other 20,000 over a 27.5-year period, now we're bringing it down to this 5 or 15-year period. Simply by us making this calculation and making these tax plans with our CPA, and again, everybody's different, but if this works for you, by using a cost segregation analysis, we can take our depreciation now from that $363 a month, and we can bring that up to almost $581 a month. So again, what we're doing here is figuring out how long it is we want to depreciate it. And the shorter we depreciate property, the bigger the deduction is going to be. So by us shifting some of the property from 27.5 years down to this 5-year period, we're jumping up the depreciation deduction from that $363 per month up to $580. So big jump in deduction here just by us making this cost segregation analysis. Now, what if we want to now look at cost segregation with bonus depreciation? What comes into play here is that $20,000 that we were depreciating over a period of time, we're now being able to expense that this year. So what we look at here is our per month is actually going down quite a bit. I'm going to jump to the prior slide and show you that the per month before was going to be $363 or $580, depending on whether we use this cost segregation or not. So that was our choice, $363 or $580. Now I'm telling you that those numbers are going to go down to $300, $303.03. And the reason for that is that I'm really reducing the amount of the building down to $100,000, and instead of depreciating that other $20,000, I'm taking it as an expense. So I'm putting in that carpet and taking it as an expense this year. And if that is $20,000 using a 30% tax bracket, yours could be considerably higher or lower depending on where you live and how much money you make. But what we've done here is upped our depreciation to 20 grand, and we've just put $6,000 into your pocket. And so again, how you play the game here, how you allocate the numbers, how all this stuff comes out is really going to be between you and your tax professional and how you implement the tax plan. Because the question is, do you want $363 per month? Do you want $580 per month? Or maybe you want $303 per month, but you want to throw an extra $6 grand of cash in your pocket. And so again, this all plays into your tax strategy, what it is that you're trying to accomplish, and how you plan to get there. And again, you got to have the plan to be able to avoid this sort of a phase, right? So yeah, you're going to be paying taxes. The question is, to what extent? Okay, let's look at 1031 exchanges real quick. And again, I've done webinars on this entire process, but one of the things that we look at is if we're going to have a tax due when we sell the property. So before you go to sell it, make sure you know what the estimated tax is. So if you bought it for 100, you're going to sell it for 200. Make sure you know that if you have a $100,000 capital gain, what are the tax hits going to be before you do it? Because we may want to do a 1031 exchange so we don't have to pay tax. So what is a 1031 exchange? Well, 6 requirements. First one is that we have to use an exchange of properties. So it has to be real estate for real estate here, qualified use, meaning business or investment. We're not going to use this as our personal residence. It's not excluded. So we can't do this with stocks or bonds or mutual funds or notes or other types of securities. This is only for ownership in real estate. They have to be like kind, meaning real estate for real estate. It can involve any real estate in the United States. So we can't get into doing real estate from the US to, let's say, Canada or some other foreign country, but we can do real estate in the US, let's say commercial for residential, investment for farmland, any sort of real estate within the 50 states is going to be considered like kind. And then there's no boot thing. The boot, all that means is cash. So if you walk away from the closing with no cash in your pocket, we don't have any cash coming to you, and we don't have any boot. There's a technical term there. And then timing requirements, which I'm going to show you here within this slide here. And I like this particular slide because it really gives us an opportunity just to look at the property and how this is going to play out. So you've got a rental property, you've held it for however long you've held it, 10 years, let's say, and you've got a $100,000 capital gain. You call up your tax pro and say, what is this going to cost me in capital gains taxes? And so this is the call that you have. Well, you're a high income taxpayer, you made 100 grand, but you're going to have to pay this 20% gain to the IRS. And guess what? The Obamacare, this Medicare surtax of 3.8% kicks in. And guess what? Since I'm doing this webinar from Colorado, I'm throwing in the Colorado state tax of 4.63. Now, you may live in a state that has no income tax. So we were just in Dallas, Texas. Texas, no income tax, so you could eliminate this line. But you also may be in California, where I was just a week ago as well. And the California tax can be 13.3. So you can just see that you come to your accountant, the accountant says, look, you're going to owe 28 grand in tax, and you're going to walk away with about 72,000 in proceeds to you when it's all said and done. You don't like that. So let's go back and you say, I want to avoid this. So before I even put my property up for sale, I identify my UI. That's this qualified intermediary guy on the far left there in sort of the brownish color suit. Anyways, I identify this person, and then I go and I list my property for sale, just like I would sell it any other time. And once I have that property sold, this is where the 1031 really starts. At the closing, notice that I don't get the money. So that arrow with the money going up to the top goes to our qualified intermediary. So I don't touch the money at closing. And if I do, it's called boot, and that's taxable to me. So in this example, I could say, I want $10,000 and take the other $90,000 and we'll do a 1031. That's perfectly fine. I just pay tax on the 10 grand. But in this case, I'm going to go ahead and I want to defer all the tax. So at the closing, all of the property, after the closing costs are paid, after the title is cleared, it all goes to the qualified intermediary. And at that point, my clock starts. And that's the 45 and 180 days rules that we're talking about in the timing. So at the bottom, you can see that from the date of the sale of my property, I have 45 days to identify another property. And this can be anywhere in the United States, but I identify that in writing. I have then from the date I sold my property, this 180-day period to actually close on one of the properties I identified within the 45 days. You can see we've got these timing issues, and like I said, this can get pretty complicated. I don't want this to be a webinar on 1031 exchanges, but I do want you to understand that if you have a capital gain and you don't want to pay the tax, 1031 exchanges are certainly one way to avoid it. So we look at ways that we don't want to pay this 28 grand. Let's look at a 1031 exchange. Now, you may not like the 1031 exchange, but it's an option. And I think what this slide shows is that you can continue to do these 1031 exchanges over and over and over again. So for purposes of this slide, I took in March 1st of 2017, I bought a house for $150,000. I'm assuming here that every year the property goes up 5%. And so in 2021, I get ready to sell it. I've got a $32,000 gain. I don't want to pay the tax, so I exchange it. And I just keep exchanging all the way down the road here until I get to 2029. At that point there, I look and my basis goes back to the 150, and I look and my accountant says, you have a capital gain of $119,377, and you're going to pay tax on whatever the rate is in 2029. At that point then, we can do estate planning and make this an inheritance issue. We can also do another 1031 exchange, or we can sell it and pay the tax or whatever it is. But notice you've got the options in doing all of these different sales here that in 17, 21, 25, and 2027, all these are just hypothetical, obviously, examples, but it gives you the opportunity to decide when you actually incur the taxable event. And with estate planning, you can have an inheritance issue where the taxes are never paid. So again, you want to be looking at income taxes, you want to be looking at estate taxes, you want to be looking at ways that we can figure out how to avoid the taxes. So quick course there on the 1031s. I've mentioned the personal residence planning. That comes into play quite a bit as far as being able to exclude capital gains when we sell it. So very, very attractive. If I'm married, I file joint with my spouse. $500,000 of capital gains can be excluded from my sale. So if my house isn't even worth $500,000, we're in that position where we're not going to pay tax. Yes, property taxes. Yes, mortgage interest. Work. We have this 14-day rule, which I know has been talked about in some of the corporate webinars in the past with Protect Wealth, so I won't get into that other than it gives you a way to obtain tax-free income. And again, that's tax-free, not tax-deferred. We can also look at maybe converting rental properties to personal residences and being able to use that big capital gain exclusion. But all of this requires long-term planning. And I think you can see that if you don't have this long-term plan, you're really going to lose out on the tax gain. You just really will. So we look at this long-term. What can we do personal residence? What can we do with our rental properties? And how can we avoid taxes? The downside with a 1031 exchange is that the exchange has to be real estate for real estate. And a lot of the people that certainly that I see at the different live events that I go to, certainly a lot of the folks in Dallas at the summit, were making money in the stock market. And so now they have all of these capital gains in the stock market and want to diversify. So they may want to throw certainly some of them back into the market, but what about if we want to take those gains and put them into real estate? Unfortunately, 1031 exchange does not work here. But what could work is what's called these opportunity zones. And these are brand new in the sense that these did not exist before 2018. But what the government has done is said, look, we want to give you the opportunity to invest in these distressed economic zones, And by doing so, by throwing capital into these zones, we're going to give you some real nice tax benefits. And the tax benefits are really nice. So if we go back and let's say we're in a situation where we do have big capital gains in the stock market or in real estate, we can now invest these into an opportunity fund that invests in these different opportunity zones to encourage the investment in getting these massive tax benefits. Massive tax benefits meaning that if we keep it 5 years, 10% of our original capital gain, we don't pay tax on. We hold it another couple years to get us up to 7 years altogether, a total of 15% of our original capital gains we pay no tax on. And the real bonus part here is that if we hold this at least 10 years, all of our profits in the opportunity zone become tax-free. And this becomes such a huge potential opportunity that, again, it's something that I think you need to look at. Doesn't mean that everybody needs to take all their capital gains and forget the opportunities in the opportunity zones from a real estate perspective, but people end up chasing the tax benefits. And that is absolutely a recipe for disaster. What we want to look at here is how best can I allocate my funds? And if I've got a really good investment in a place where, let's say, has been, let's say it's a neighborhood here where, to give you an example, in Denver, where when I first moved here, there was no Coors Field and all the baseball and stadiums with the hotels, restaurants, and everything around there. It was actually a pretty dumpy area. And so what they could have done had opportunity zones existed at that time is say, okay, we're going to encourage people by giving you tax benefits to invest in this area, which is really a pretty crappy area of town. And by doing so, you can gain some real nice benefits. So let's look at this opportunity zone in just a hypothetical example. Investor A and B, we both have capital gains. It can be in 2018, we can switch that and put that in 2019 as well. And so I did real well in the stock market and made $100,000. Investor A here takes those gains and dumps them back into the stock market, where investor B instead finds one of these opportunity funds and says, okay, I'm going to put my capital gain of 100 grand into this opportunity fund, and it's going to invest in something that, let's say maybe some low income housing in a particular area, or areas that are starting to turn from maybe warehouse to residential or warehouse to commercial or whatever. So I put my money in there. Both investor A and B both earn 7%, and both of them hold it 10 years. You can see that investor B is more than doubling the return of investor A, and the difference here is solely taxes. So if investor A is paying taxes, did pay taxes on 100,000 of gain, so they don't even have 100,000 to invest, right? They're paying tax up front. But you can see that assuming that investor B in this opportunity fund is a good investment, investor B comes out way ahead. And again, the sole difference being taxes. So let's, I'll sort of leave this webinar tonight with the example here that I would like to use for this opportunity zone, just to show you how this plays out. So we have here a very simple example. Homer buys 1,000 shares of Microsoft, pays 46 grand for them, sells them this year, pays or gets 110,000 in return, subtracting the 46 from it. Homer's got this capital gain of 63,460. Homer then decides, that's fine, I'm going to pay 20% in capital gain tax. Let's say it's 15% to the IRS, 5% to the state, whatever it is. Homer pays the 12,692 and walks away. So Homer gets whatever, 51,000 or whatever that's left over after the 63,000 minus 12,000. So we're good here. Homer pays the tax. Everybody walks away happy. But what about if Homer doesn't want to pay the tax? So now Homer's going to take the proceeds here, his capital gain, and within 180 days, he invests the money into an opportunity zone. Now that can be the 110,000. It could be only the 63,460, the capital gain. So Homer can put what he wants in there, but the capital gains is not taxed in 2018. So by Homer putting at least the $63,460 of capital gains into an opportunity fund, Homer does not pay the $12,692 in tax. So assuming that this opportunity fund is a good investment, it becomes a really good investment because we just saved over 12 grand in tax. So really nice opportunity here. No pun intended with the opportunity zone. Bullet point 3, though, talks about what happens if Homer keeps that investment for 10 years. And let's say after the 10 years, that $100,000, the $110,000 that we initially invested in now goes up to $310,000. When Homer sells that in 2028, that $200,000 capital gain, tax-free, does not pay a penny in tax. And so the only thing in this whole scenario that's going to get taxed is that the $63,460 of capital gains is going to be taxed eventually, but we're going to start getting a reduction of it. And so when I mentioned that if we hold it for 5 years, 10% of it isn't taxed, what that means is that of that 63 grand in capital gains, in this case, $6,346 will escape taxation, and then another 5% if we hold it another 2 years. So all this plays out really well with one big assumption, and that is that the opportunity zone investment better be a good investment. Taxes make it a great investment, assuming it's a good one otherwise. So a couple final thoughts here, 3 final bullet points. You notice the tax plan in red. I'll say it 3 times because you better have a tax plan in place before you buy the property. In other words, why are you buying it? Tax plan in place while you are owning and operating it. This is where all of our tax deductions come in. And then tax plan number 3, what are we going to do before we sell the property? Do we want to pay the tax? Do we want to defer it? Or do we want to make it a tax-free transaction? So tax plan, tax plan, tax plan. And with that, I will now look at some of the questions that we have. And just again, want to thank you for listening through this particular part of the presentation. I know it's a lot of stuff being thrown at you, but again, just pay attention to what could apply to you. And let's get a tax plan for you, not for everybody else, but for you. So Kendall, questions, or Don, questions? Where are we with everything?
Yeah, so we've got a question from Aziz. Do mobile homes qualify as real estate? Good question.
Very good question. Typically, no, they don't. And so real estate's going to qualify as personal property, which actually makes things pretty nice for us because then we have much shorter depreciation periods for doing that, and we can still qualify for the qualified business income. So really good question, and bonus depreciation as well.
Yeah, but if we took off the frame underneath and you mount it, my understanding is that now it changes from a mobile home to a manufactured home, and it does qualify. Is there anything in the tax code that identifies that? And again, I'm listening to Aaron Adams all the time on real estate, but manufactured homes, once they're mounted, the frame, the wheels, everything's been removed, and we put them on the real estate we mounted on. Does that now qualify for 1031 exchange or an opportunity zone?
Well, I think it would at that point, because what you're doing is you're taking something that personal property by definition would be mobile. You can move your computer or whatever, and if you're putting it now onto the foundation where you're taking away its ability to move, then yeah, we've got a personal structure, and that is now going to be real estate.
Cool. Okay, Tim is asking, we were doing a 1031 exchange, but the purchase price on the new property is $35,000 less than the sold property. Can we put that into an opportunity zone fund to defer the capital gains? Good question, Tim.
That's a really good question, and that's one I haven't seen the answer to that yet, as to doing split transactions. And what you're talking about here is that if you're selling a property, let's say for 100,000, and the property you're replacing is 65,000, so you have this $35,000 difference, that's going to be a taxable hit to you. So you'd have to put 35 grand into the transaction, or you take that as a tax hit. And what your question is, and I don't know the answer, would be, can we now take that 35,000 of gain and put it into an opportunity zone? And my thought on that would be that you absolutely could do that, because it's a capital gain that you're going to be taxed on, and any capital gain can be deferred if it goes into a qualified opportunity fund. The reason that I'm hedging and I'm saying I'm not sure is that we have a split transaction between a 1031 and an opportunity fund, and I don't know if the IRS is going to allow that. I would think they would, but again, that's just my opinion now.
Okay. I've also seen little amounts. Let's say, Tim, you put your 35 or 65 into the new home and into a real estate investment trust. I assume, Scott, that REITs can qualify for 1031 exchanges as much as real estate property. Is that still correct?
If we're doing an actual REIT, that's a good question on that, because when you get into, like, there's a lot of publicly traded REITs that would be doing that, and I don't think that they would qualify for it, because it's a securities. But if we have a private one, we'd have to look and see, because if it's a security, then we're not going to qualify as a 1031. We could, though, qualify as an op zone, no matter how it's gained, so publicly or privately. Yep.
Good. Okay, John is asking, can you get any tax deductions if a property is part of an IRA?
That's a really good question. I mean, typically you don't need any particular deductions when it's in an IRA, because you're not going to be taxed on any of the income. But there's a big caveat there, and that is that let's say we're using a self-directed IRA and we have financing in there. So we have a non-recourse loan against our property within the IRA. That can generate what's called UBIT, and that can generate an income tax within an IRA. So a lot of people think, oh, we'll just do real estate in an IRA and there'll never be any tax. And that's not the case. So if you're doing leverage there, we've got UBIT, then we definitely want to keep track of our expenses to make sure that our IRA doesn't get hit with this tax. But in general, if you're not financing it, you typically are not going to have to worry about the expenses.
Great. Okay, Benjamin is asking, will this webinar be viewable in an archive? Apparently he came in a little late, so I'm going to open that up to you. I know that these are being recorded, and they're usually free. Correct me if I'm wrong, for a couple of weeks, and then after that they go into the archive, where it costs $129 a year to have access to everything we do. But it's such a huge, vast library, it's well worth the $129. Kendall, do you want to add anything to that?
No, I think if you want, basically, usually within a couple of days after the webinar, once the recording's available, we'll have that available in our archive for 30 days before it goes into the premium library. So yeah, you have copies of the slides there within the recording, and if you're a member of the premium library, it will go there usually within 30 days.
And Benjamin, anybody that signed up for this webinar, registered, whether they attended or not, or whether they were on time or not, should get tomorrow, watch your emails, you should get a link to that recording. So yep. Good question.
Okay. Yep, that's perfect.
So Tim is asking, can we get a copy of the slides? No, but you can get a copy of the recording, and that will, but the slides themselves, Scott keeps those, and they're his intellectual property, and so you can get a copy of the presentation if that helps. All right, Gigi's asking, how do I get find a professional with your expertise? Well, I don't think you can, but Scott, let me turn that over to you. Um, how do you get somebody that can do that's really good in real estate?
Well, I think the first thing that I would do is find somebody, well, hopefully local. I mean, you can certainly go out of state, and I don't prepare returns, but when I was doing it, I had clients in all 50 states, and that really didn't make any difference to me. But I think you would look for a preparer that actually does real estate, and what I mean by that is, do they have a rental property? Have they ever owned a property? Have they ever flipped a property or whatever? And so, somebody like myself, I've never flipped a property in my life, but I've had several rentals and still do, and so I understand a lot of the real estate strategies. And so I would talk to different people there, that may be in that sort of line of work. Go to a local real estate club. We have some RIA clubs here in Denver that, there's always accountants that'll be showing up that apparently, or they at least advertise they have that expertise. And talk to other people that are investing in real estate. When I was in Dallas there were, I would say a good 60 to 70% of the room was real estate investors. And, you want to find a good CPA or something, start talking to other investors, because they can tell you, hey, that guy was great, or that person was horrible, or whatever. But get somebody that knows what they're doing in the specific area that you are doing. So get a real estate person, or if you're in a small business, get somebody that specializes in small business so that you get them in sort of their area of expertise.
And Gigi, if I might add, find an accountant or a CPA or somebody that actually has real estate, not just somebody that claims to know all about it, because I've never found a professional that was really good that didn't own real estate. Scott, your opinion on that?
I agree. I mean, unfortunately right now I'm going through an eviction at one of my properties. And so, I've seen, when you sit back for 6 months and nothing happens and the money just comes in, and then sometimes it doesn't go well. And what are the strategies and how do I get out of deals? And so I think, I've had it personally. I know what it's like to have skin in the game, and I know what strategies I've used. And then I think you can take sort of the theoretical stuff that I've thrown up here, tonight, as far as, wow, these are some of the possibilities. And now, really go and implement them for ourselves, figure out what we need to do.
Okay. Good. Okay, so we have a question. Can we do a 1031 exchange on your mother-in-law? No, it was a joke, but it was a really good joke.
The one, but just make sure it's like kind.
Are we talking male to female? Or are we talking, I don't know what like kind that means.
Definitely an upgrade.
Move on to the next question.
Yeah, I think we better. I think we're going to get in trouble if we stay too long on this one. My wife is a partner in a limited partnership that owns commercial property. If we sell our share in the entity at fair market value of the property, is there any way to do a 1031 exchange on our gain?
So that one's going to get kind of complicated as far as who would own the property. And one of the things to keep in mind is that when you do a like-kind exchange, whoever is on the sales side of the property has to be on the receiving side, the buy side. So if you have ABC LLC doing the sale, ABC LLC has to be the one on the other side of the 1031. And so that sometimes comes into play, especially if we have interests that are being split. So if we have, a partnership LLC and you have multiple interests that being split, or some doing 1031s and some aren't, you've got a whole nother set of issues there as far as the planning goes.
Okay. Are deductions generally more favorable for rentals or for flips?
Well, they're going to be two different things. When you're looking at flips, all of your deductions really go into, they all get sort of merged into your expenses all together, where, in other words, when you're doing flips, you don't have to worry about depreciation expenses. because your real estate is considered to be inventory in the business. And so we don't really worry about, well, if you have $50 of telephone and $100 of this, we just throw $150 into the expense pot and it all comes off the top, and things are a little bit easier because we're running a business. Where we get into the rental property stuff, it just goes on a different form. It's treated a little bit differently, but you're still going to get the same dollar for dollar value on the deductions itself, just allocated a little differently.
Okay. What if, all right, let's see. What if an opportunity zone, what if it is an opportunity zone REIT? Don't know.
Well, typically you're going to see now the opportunity funds will run investments in an opportunity zone. So let's say that, like in the United States, for instance, there's about 8,700 opportunity zones. And when I was giving a talk in the Bay Area last week, there was something like 860 of them in the state of California. And I'm using some round numbers there, but that's about what it was. And so it's possible that you could have an opportunity fund that could invest in 200 different opportunity zones and have all these different investments going. Then you could look at and say, well, how is that opportunity fund going to be set up? And there, I guess your question is, could that be set up as a REIT? And I'm not sure why we would do that. I mean, typically they're going to be set up as LLCs, limited partnerships. You could get into some corporate structure, but you typically would have a couple of different entities involved there. But again, think about the opportunity zones as big chunks of land, and look at an opportunity fund kind of like an investment fund or a mutual fund where you can put your money in, and maybe it'll all go into one building if that's what you want, but it could go into multiple buildings and sort of diversify within multiple opportunities. So a lot of different possibilities there, I guess is what I'm getting at.
Okay, good. Ross is asking, in a 1031 exchange, can you sell one property and buy two or more properties? Say you sell a property for 100,000 and buy two for 50,000 each. Can you do that?
Wow, and that's like, again, this is why I like doing the classes, either the webinars or definitely the live events, because there's somebody right there that's like thinking a little bit outside of the box, in the sense that I didn't say anything about doing a 1 for 2 or 1 for 3, right? It said you can trade 1 for 1. But the reality is that you can do 1 for 2 or 1 for 3. And so, Ross, you're absolutely right. You could sell your $100,000 one and then exchange it into a 50 and a 50, or a 30 and a 70, or whatever it happens to be. So you've got a lot of flexibility there, as far as what you're getting out of, and then also what you're getting into, and numbers and whatever. Or you look at it, you could get out of $1 million commercial property and go into 10 $100,000 residential properties. So there's lots of different ways you could play this game, depending on kind of what is it that you want to accomplish. What are you trying to do?
A lot of you have seen Aaron Adams on our stages or on our webinars. I remember about 3 years ago, he helped somebody get out of a commercial property in California and get into 14 residential homes, all as part of one single 1031 exchange. So the answer is absolutely, it's done all the time. So it has to be equal or greater value, but it can be as many properties in that as you'd like it to be. Okay, so Benjamin, when you mention leveraging in IRA real estate, I assume you're talking about an HML, local bank transaction finance. Is there any other type of situation that would generate a taxable event inside an IRA, like a Roth?
Well, you could have a taxable event in a Roth or a traditional. You're looking at leveraging a property. So if you're using any sort of loans or whatever on a piece of real estate in an IRA, that is potentially going to get you hit with the UBIT. Okay, so that could be a taxable issue. The other one is if you're running a business within your IRA, and you can do that. So I've seen people flip properties in their IRA, which is perfectly legal. The downside is that you're running a business within your IRA, and flipping those properties can generate UBIT. Just like if I was going to run my law practice in an IRA, I mean, there's reasons why you don't see people running businesses in their IRA. And the reason for it is that you get it with UBIT, and UBIT can be much higher taxes than the current income tax. So we don't usually want to run a business in an IRA. That's why we don't normally flip houses in an IRA.
Okay, good. Does Scott give a class on small business tax strategies?
That's a good question. I don't as of right now. I would like to make that actually a part of the 3-day event at some point where we do a 1-day breakout class. But as of right now, I don't have anything scheduled for next year as far as me going in and just, you know, it's just me and we're knocking out all these tax planning strategies in a, let's say, in a 6 or 8 hour day type of session.
That would be a fun thing to do at the 3-day summit. Scott always spends at least an hour on taxes for businesses, and generally that we're talking small business. We're not talking large mega, you know, publicly traded companies. We're talking. Scott's very practical that way, and he'll spend at least an hour on personal taxes and how, and then at least an hour on business taxes as well. But Scott,
right, yeah, the 3 days done. Yeah, I do the business tax and the personal tax is the other, and the personal has real estate in there. And so, you know, I think there again, what we're looking to make sure at the 3-day is obviously you're thinking about taxes, but then we can also bring in, you know, maybe there's a new ruling or something came out that we can keep everybody really up to date, the most cutting edge, you know, this is as of today type of thing on that. And so, I mean, the 3-day events definitely play in real well in that.
Yep. Okay. Does a 1031 exchange help avoid dealer status?
1031 exchange, no, it does not, because a real estate dealer, by definition, does not have an investment property. And so dealers that are going to be, a real estate dealer is basically somebody that's flipping properties, and it's a negative tax connotation because we lose some tax deductions as a dealer. But we can't just avoid that with a 1031 because, again, a 1031 exchange is investment for investment. Dealers don't have investments. If you are going to be like a flipper, let's say, and you are a dealer, and let's say that you also have rental properties, let's say on the side, we want to split them. And so what I would do there is I would have my own entity, whatever it happens to be, that's doing my flips. And then I would have, let's say, an LLC over on the side that holds my rental property. And so that way, if I want to do a 1031 exchange on the rental, I can do that into the same LLC, and I don't involve my dealer entity. So again, that's something where you get into a little bit more complex planning because we have a dealer entity and we have a sort of a buy and hold or an investment type entity or entities. And so we have to do some kind of cross planning to make sure that they don't really impact each other negatively.
Okay.
Hey, Don, are you guys okay if I interrupt? I got another question actually came in via email. She wasn't able to send her question in.
Sure.
This is Isabel. She says, I have a rental property. How do I approach the following? Let's say I sell it for $6 million, a new building on the block, which is 2 stories taller and has an elevator, is on the market for $14 million. Should I sell my building and buy the new one, or should I renovate, update my building, and spend millions with something similar to the building I mentioned with less debt and more equity?
Right. So you see where, obviously, I can't answer this question here, but do you see where this is going as far as all the planning here? So there's lots of opportunities here. You can take your building right now, do a 1031 exchange on it for the higher price building, and kick in the money difference. Obviously, it's a lot of money in this situation. But if you've got big capital gains, that might be something to look at. The other thing is you could renovate your current building look at maybe bonus depreciation on some of that, of the renovation costs, and get your deduction up front. Or maybe you renovate it and sell it and put the money into a new building. So, you know, you've got all these different options as far as what do you really want to do. And I think what I would do here is I'd run all the numbers and see, if I sell my building and buy another one, here's what my tax situation looks like, you know, looking at all the different numbers versus a 1031 versus an opportunity zone versus, you know, sell and buy or whatever it happens to be. They all become really sort of complicated but complex math problems. And how you allocate the numbers, I think, will sort of answer that question.
Savvy planning. That's great.
But Scott, I really like what you said. If it's not a good investment without taxes, it's probably not going to be a good investment with taxes. The taxes are I mean, you can make them the sprinkles on the cake, but don't try to make a bad investment and then work around it and make it a good investment by tax planning.
Right. And we don't want that. You know, I've heard situations, oh, well, you put $1,000 into Enron, right? And the next day it's worth zero. And you say, well, you know, we can make it okay here. We at least get $1,000 tax deduction. It's like, yeah, that's true, but we don't want to be in that position. And real estate is, let's make sure that your investment is, you know, on paper, it's a good investment. And once you run the numbers and go, hey, this looks like a good investment, now let's figure out how we can take that good investment and really make it a great one with taxes. But we still got to have a good foundation. We got to have a good investment to begin with, or else, in my opinion, the tax planning isn't really worth anything.
Great. Okay, Mark is asking, if he finds a grant, either for himself or his business, does he pay taxes on it?
That one is, it depends. It depends on the type of grant. Some of them are tax-free. They can be like scholarships or whatever. A lot of grants are taxable, so you have to look at the specific grant, unfortunately.
Darn, I thought that would be an easier question to answer. How do you find an opportunity fund?
Well, you can start off by, you know, what I would do there. I mean, you can Google opportunity funds, and you'll come up with way more hits than you ever would want. I've done this, and so I try to be very narrow on it. Like if I want to, you know, let's say I'm in Denver right now, so I might Google in opportunity fund Denver, Colorado, and see what comes up. And then I may even narrow it more to see, well, you know, there's these 10 zones in Denver that look like they qualify. What kind of investments are here? You know, do we have warehouses, or is this a parking lot, or are we, you know, what is it that we're trying to do? And that's where I would start. But again, you've got to do your due diligence, because you're basically giving them your money to invest. So you better make sure that not only is the investment good, but the person making the investment is good as well. You know, and so these are things the investment comes first. And once you're good with the investment, again, and I can't emphasize it enough, but if the investment isn't good, forget the tax benefits. The investment has to be good first.
Good. Martin is asking, can you possibly get hit with UBIT tax in your IRA or Roth if you're building starter homes?
If you're building starter homes, again, it would go into the leverage part. So if you're building, you know, I mean, if you're building like a whole development, then you're probably a real estate dealer, and you're probably in business, and you have UBIT. If you're building a starter home and you're doing it with your cash, so that there's no financing involved, then you're probably okay. So again, is it a business? If so, you have UBIT. Do you have leverage? If so, you have UBIT possibilities there. And that's really what you have.
And it doesn't matter what the investment is. It's, are you using leverage, and are you actively running a business? So by the fact that it's a starter home doesn't determine whether there's UBIT. It's are you actively running a business, and are you using leverage?
Correct.
Am I right on that? Yeah.
Yep, sir.
Okay, good. All right, Benjamin's asking, does UBIT apply to solo 401k set up as a pension that has some flips and other rentals?
Well, I mean, we're sort of mixing things there. I think I would I'd sort of back away a little bit and see that, you know, if we're using any sort of a self-directed plan where we're telling the custodian of the IRA, B, you know, if you're flipping properties, that's UBIT, and it doesn't matter where you're, you know, what sort of a tax deferred sort of an entity you're doing it in. If you're flipping properties or running a business, you're going to have UBIT issues.
Yeah, and I think Benjamin, I think what you're asking, I know that there's less self-dealing problems in a solo 401k than there would be like in a traditional or Roth IRA. But the issue, so, but the issue still comes down, and it doesn't matter if you're doing a Roth, a traditional 401k, whatever you're doing, the principles still apply. It's, although the self-dealing is really kind of a different issue. Are you using leverage, and are you running a business? Scott,
Correct.
any thoughts?
No, I think that's pretty straightforward. And again, what Congress doesn't want people to do is to be able to use their IRA, 401k, whatever it happens to be, and gain an advantage over everybody else that's in business. And so if you're going to run a business or you're going to do something where you're not doing investments, then the IRA or the 401k or whatever is going to have some other hurdles to jump over. You know, I mean, you've got other things to deal with here, where understanding that a 401k was set up for you to put it in the stock market or put it into bonds or mutual funds or all of this stuff where you don't typically have leverage. And you're not typically running a business when you're buying a Fidelity mutual fund. So what we're doing here is, you know, over time, different people wanted to do different things in their IRA. And once you start getting into stuff that's more active and not just a passive investment, then new rules were developed just to make sure that the taxes would be fair to those that aren't doing it that way. So just a different way of looking at it.
So he goes on and says, should I just use my retirement accounts for, you know, like passive real estate rentals? And that would be safer, but there's
well,
enough.
I think down there you're getting into, you know, you're getting into some investment advice though there, as far as, you know, who knows what, you know, everybody can be a little different. And, you know, sure. I could have $50 million in my IRA, and if I ask somebody, hey, should I put a couple rentals in there? Probably, you know, the financial planner, yeah, sure, why not? You know, get some diversity as far as your diversification, as far as your investments or whatever. And, you know, in this case, you know, whoever, I didn't get the name, but whoever asked the question, maybe they have 100,000 in their IRA and they put it all into one rental property, and something happens at that rental property. Just like if they put it all into one stock and something happened with that stock, you could end up in a bad situation. So I think everybody has to determine, first of all, you know, what are their investment goals? What's their risk tolerance? What are all these different things that an investment advisor would look at? Get with an investment advisor if you have a lot of different types of investments or you have money to invest. Figure out what's going to be best for you, and then the tax plan will come once you know what it is you want to do, whether that's putting your rentals in an IRA or 401k, or putting it in a taxable account and using the tax benefits to offset other income. So lots of different scenarios here depending on what you're trying to accomplish.
Yeah, and when I mentioned it's safer to have rental properties, I really meant to avoid self-dealing, you know, implications. I don't know whether the investment is safer or not,
right,
but certainly,
yeah,
you know, IRAs are traditionally, if you've got a custodian, you can, are traditionally for passive investing. 401ks when you want to be a little bit more active. Okay, and do flips, but either way, I don't know about the investment, but it won't affect your UBIT taxes. Solo 401ks are set up, and the flexibility is there so that you can flip property and be more active than if you were just using traditional, you know, or Roth IRAs and having a third-party custodian. Yeah. So anyway, so Scott, looks like we're done with questions. Any closing thoughts on real estate investors?
Well, I think again I'll go back to the dreaded P word, and that is plan. You know, if you're not planning on this stuff, you're going to miss out on so much. And you know, one thing I don't like to see is, let's just take the Dallas event that we were at, since it's still fresh in my mind. But seeing somebody like Aaron Adams on stage teaching people the real estate component, and then you go ahead, you implement this, you're successful at whatever it is that you're doing, and now you give all that money to the government because you don't have a tax plan in place. And so you got to have the plan in place before you buy the property, while you own the property, and before you get rid of it, to figure out how we can maximize this. And just think about, the more money you save in taxes is the more money you can put into your next real estate project or whatever your investment is. But I think just remember, it's your money, not the government, and you should be able to decide how you spend it. And tax planning gets you to that point.
And that's something that we really, I think, want. Getting deductions, accelerating our depreciation now, taking more of it now. It's so that you have more money to invest in real estate or stock market or whatever. You've got more money working for you. It's not about evading taxes, and it's not that we hate the United States of America. But if we can reduce your taxes by $50,000 this year and put more money into your take that money, put it into investments. Wow, that can be a game changer year after year after year after year when you go to build your estate or you build for retirement. So, Scott, thank you so much for being here with us. Your expertise is so valuable for us. We appreciate that. Um, I think that's all we have. Next week's webinar will be on identity theft. There will be this will be recorded. Has been recorded, and it'll be available to everybody. You're welcome to share that recording and send it out to other people and share it with your friends and group members, however you'd like. So to everyone on the call, we appreciate your time. We appreciate you being here. Scott, especially for you and your time and your expertise. Tell your family hi for us, would you?
Thank you very much. Take care.
All right. Good night now.